Good evening, everybody. This is Jeff Gibby. I'm going to have the pleasure of reading a legal disclaimer for you today. And in addition to that, I'm going to kind of introduce tonight's guest speaker, who is making his very first appearance in the MetaStock training room. So we're excited to have him. We're happy to have him. And I'm glad he could join us today. I do want to introduce our guest tonight. Ken Calhoun is somebody who's been in the industry for a huge amount of time, and somebody that we've definitely wanted to kind of coordinate some marketing efforts. And I really think he's got a very unique view of the market and something that is going to help you. So I wanted to bring him into a training class, and he has agreed. So definitely somebody that I really, really like in the industry, definitely somebody that's been really a presence and a force in the industry for a long time. And with that being said, I'm going to get out of the way. Ken, come on in here.
Hey, all right. Thanks, Jeff. Good to be here. I wanted to welcome everybody to tonight's live presentation. This is Ken Calhoun coming at you live from the chilly Rocky Mountains here in Colorado Springs, and we will get underway. Now, really pleased to work with MetaStock. I've been expanding our strategic relationships, and MetaStock's been long on my list of companies that I wanted to work with because they've got an outstanding trading platform and a charting software platform, and I wanted to start by teaching you some of the very best breakout strategies. I found I've traded millions of dollars worth of stocks, ETFs, minis, and Forex over the 15 years I've been around. So let's go ahead and get started with tonight's event. How to trade high momentum breakouts with MetaStock. Virtually everything you'll see tonight is on live charts. Okay, that's how I teach. But I do have a few PowerPoints to get through here quickly. Probably 362 plus on my end. The same thing. All information is for educational use only, not making any buy, sell, or hold recommendations. Let's go ahead and get underway with tonight's event. For those of you who may not be familiar with me, I've been a publisher and active trader for over a decade. You may have seen me in this last month's issue on price action entries, stocks and commodities. I speak at the Traders Expos. My 30% rule, let me get started with just a quick tip on breakouts. Much more important that you scale in, as my colleague Van Tharp would talk about. This is actual trade confirmations of a day in which I made 660 net in real trades the hard way, right? It's a lot of trading activity to just generate 600, but my 30% rule is that when you're trading breakouts, you take a lot of shots at the market and you're trading in and out of a lot of different positions, and your goal is just to walk out with more money than you donate to the market, right? So my goal is you need to figure out, or a strategic shift point, something I would encourage you to think about is figure out how you can still make money in your trades being right only 20-30% of the time. Most of my professional trading clients are right under 50% of the time, and so don't worry about being right 80% of the time to make money as a trader. The goal is to be right larger than you're taking small stops. Now, I don't know if you're a day trader or if you're a swing trader. If you swing trade, you know that we like to trade large size and go for larger gains. If you're scalping for day trades, it's in and out. Regardless of what style you trade, we're going to be looking at stocks and Forex for day and swing trading breakouts in tonight's live event. So let's go ahead and get started. Here's the learning goals for tonight. I want you to learn how to enter strong momentum breakout trades. I'm a real trader. I'm not just some educator that talks about chart patterns. I just proved it with screen caps of real trades I make, so you know I'm the real thing. I want to teach you how to enter strong momentum breakout trades, strategies for avoiding false breakouts, and I've got some new ones for you tonight. With rally markets in place, there's never been a better time to learn how to trade breakouts professionally. So I want to give you my take on it using the MetaStock platform. We also want to look at top moving candlestick and cup breakout trades. I've worked for over 12 years now with my colleague Steve Nissen, and we've co-produced various trading systems together. I've learned a lot from Steve. He's the father of candlesticks, the top expert. I have learned how to integrate candles with my own proprietary cup breakout techniques, and I'm going to teach you how that works tonight. And then also how to scale into winning trades with multiple entries. Okay, so here's the last PowerPoint before we jump into the charts. A few quick writer-downers. One of the things that you always want to focus on as a breakout trader is not being afraid of buying new highs unless something's extended near the edge of its previous day's average true range, or ATR. What you want to focus your energy on as a trader is only trade instruments. If there's one message I give you beyond the risk management, The one thing I want you to learn is focus your energy as a trader on trading what on Wall Street we call out days. Those are days in which the broad market, as it has been the last 2 days, is outside of or above the previous day's high. Okay, and also focus your energy on whatever you trade, whether it's E-minis, Forex, or stocks. I've tested this out with thousands and thousands of my own actual live trades. You want to give much more preference to trading things that are outside of previous days high-low, because that's where institutional high-frequency trading, OHLC-driven software kicks in, is when things are outside of previous days high-lows. So you want to focus your breakout energy on trading things that are outside of previous days ranges. We look at wide range candles, and we'll go through charts on how that works. There's a very unique way to use the MetaStock charts to identify the very best breakout strategies in combination with cup pattern. Looks like the letter U, or like this, a cup formation. Also, you want to take many entries, throw many darts at the market, plan on taking many small stops, find a broker that's inexpensive to facilitate that, and then scale in, as my colleague Van Tharp would talk about position sizing. You add to winning trades to build a position during a breakout run like we've had in the current markets. I am thrilled about our market strength lately, and you should be too. Hopefully, you've been on the right side of that as we've had great breakout opportunities in the markets. I'm going to teach you what I call acceleration ramps, price action breakouts, and the focus should be on the upper right part of the chart. So with that, let's get on with it. On to the charts. I'm going to start off by looking at those type of chart patterns that make the most sense to trade from a breakout volatility standpoint. And for example, the single best pattern that I always trade myself is a simple cup breakout. And one of the tricks to doing that correctly, the number one thing you have to get right as a breakout trader is not to get stopped out by false breakouts. How many of you, show of hands, have gotten into a trade that, hey, it looked good at the time, and then it rolled over against you and you got stopped out, only to then watch it run up without you? Can I get a yes? Thousands of traders I've worked with, that's always one of the biggest. If people raise their hands, yeah, that's the biggest challenge. Here's the quick tips. A quick tip on stocks for swing trading: you want to use at least 35 to 50 cents above the previous day's high before building a new trade. On your Forex, if you're trading currency pairs, for example, our US dollar to the Canadian dollar been especially strong lately, right? The dollar CAD had been the dollar doing good against the Japanese yen. Now our dollar CAD's been really strong, breaking the one in earlier trading. You're going to use at least 30 pips above new highs to scale in. And those are just blunt instruments. For day trading, I like using 8 to 15 cents above cup highs, the right side of a cup, to scale in. So the number one thing to do is trade outside days where they're outside of previous days' ranges. Here's a quick tip for you. To get out of breakouts, let's say you've been building a swing trade in Tesoro. Tesoro's been a really good one. I like trading this one. It's ran from 40 up to 60, right? Huge run this last several weeks. Whenever you see two red sequential candles in a row, a loss of that second red candle is always the get out here sign. Again, roughly 30 cents under the low. So that's where you put a stop to lock in gains. And that's what I'm doing in my own capital trading accounts. I won't mention the brokers I use, but the capital accounts I'm in, I like to put in hard stops after breakouts run within, say, 30 to 50 cents under the second of a red candle. And again, see, I don't see a shooting star. I don't see, I mean, there's kind of almost a shooting star. I don't see a classic shooting star up here at the top. From a momentum trading standpoint, though, I do see two red days in a row, so that's a good reason to scale out of or close out the entire trade once it's moved. Okay. Now you can see the power of cup breakouts. My expertise is in trading cups. I've traded millions worth of cup breakouts, and one of the things that I found in all that time is that, I guess in teaching traders, they're always afraid that, oh, I'm buying the high, and they're afraid that they're going to, be the person, the bag holder at the top of the trade or whatnot. And I encourage you to overcome that thinking. The best trading opportunities from a breakout standpoint are always going to be above new cup highs, and in fact, you want to scale in. Here's a quick scale in strategy that I like to use in my own swing trades. You start off with an initial trade. Let's say it's a small test trade, and I encourage you to do that, especially in broad rally markets. You might put out, say, 15 or 20 trades at a time. I've done as many as 320 trades in a given day, but that's a hectic day. Typically, I might do as many as 6 to 8 entries. You might want to start off with small size. 20, 50, 100 shares at the most, and then double into the trade or double that position once it's moved, say, 2 points in the current market, 2 points in your favor. So let's say you bought in at, say, 30.7. The next entry would be up at 32.7, okay, and so forth and so on. So one of the strategies you want to take as a breakout trader is to look at scaling as an integral part of adding to initial cut breakout entries. Okay. Now here's another one before I forget. Make sure that you're always looking for gap continuation plays, right? Here's a good example yesterday in CREE. Yesterday's market. Today it drifted. Yesterday we had a big rally move up following the gap up, right? It gapped up from 44 to 47 and ran all the way up to 52. That was the biggest runner in yesterday's markets, at least that I was looking at. And one of the things that another myth that traders get misled by is that they are afraid to buy gap up. They say, well, surely it's gone up so high, it's not going to get more buyers. It looks really expensive there. And at that time, the trick is when you're trading, that morning, you're going to just see this, and that's going to occupy the entire chart window. What you don't see is all the trade opportunity to the upside. So overcome that fear. You always focus on buying breakouts at the upper right side of a chart to scale in professionally. Okay, so I always like to buy gaps up. Again, if it's 15-point gap, maybe not, but anywhere up to, say, 20% of that price action on a gap continuation, I'll put on a first trade, and then I'll scale in, say, 2 points up on an instrument priced roughly, $30 to $50 a share, like CREE is. Okay. So when it comes to breakouts, don't be afraid. Don't beware of the gap. You want to buy gaps up and sell gaps down. You see that both in the broad market. See, minor gap continuations typically tend to run on up. Let me zoom that up so you can see. And I'll repeat, minor gaps up, my favorite single signature play. I've trained thousands of traders in how to trade minor gap continuations, and that's what we do, right? The minor gap is an institutional buy signal. Look at how strong the volume is. That's 2-week, maybe 3-week high volume on that gap day, which is typical. Whenever you see a gap, that means institutional, professional traders with a lot more money than you and I, well, maybe some of them have more than I don't know, millions of dollars worth of trading accounts. They are putting on large size on large volume. So what you want to do as a trader is professionally look for new entries following a gap in trend on a breakout continuation. Okay, it's something that another one of that. I was talking with one of my traders in Europe on the phone yesterday, and he kept using phrases and words like it's overbought and the gap's too high. No. Gaps are the #1 signature play of a professional trader. We're looking for minor gaps in trend. Okay, let's take a look at another quick tip here. CREE would illustrate this too if I put this on a daily chart. You want to look for wide versus narrow range alternating candles. So whenever you see a wide range candle day, for example, here's a wide range candle followed by 2 flat candles. There's a wide candle, 2 relatively narrow candles, and then the big move, right? Then here's another big wide candle, a narrow candle, and then another big move that launched, a 8-point run in this instrument. This is Tesoro. Look for alternating wide versus narrow range candles. The trick to avoiding false breakouts, by the way, is don't buy, with rare exceptions, you don't buy the day after. And this is a rider downer. This is important. I've published dozens of articles in the industry and all that, and and I tested it because I test all this stuff out in my own trades. I trade every week. I'm a trader. Well, when you're looking at continuation moves, do not buy the day after a wide range candle day. Okay. For example, CREE, this is 2 days worth of price action. Here's a wide range. If this were a daily candlestick chart, this is a wide range day. Here is a narrow range day. You don't buy the day after a wide range day because typically, as with markets, as we saw today, I was telling my traders in my live room this morning, traders you will see resting after a big rally. Typically, it's an alternating expansion contraction. So professional traders know this, and you guys should be aware of this too. I've got a lot of clients, professional trading clients and institutional guys, and they talk a completely different language, by the way, than most retail traders and the vendors out there that don't trade do. It's much more about the money. It's much more about the volatility, as is appropriate. Successful trading, you can quote me on this. Successful trading is a lot more about the math than it is the chart patterns. And what I mean by that is you follow things and scale in with open profit and loss, or scale your trade so that you judge the capability of the trade to continue as a function by whether or not you're right and by how much. You know, how much money are you up in the trade? How much money are you down? Or are you about break even? And you spend a lot more time. Any professional trader will tell you this, and I'll tell you too. You spend a lot more time figuring out the P&Ls and scaling up and down dynamic trading than you do simplistic chart patterns. So that's another quick tip. Going back to the wide versus narrow candles. The thing is, when you see a wide range candle, in this case, the wide range candle took and kept running. But usually you'll see a wide range candle and then a narrow candle, like right here. Here's a false breakout into SOAR. Let's say you've been following this and you're looking at it, say, for a potential breakout above that wide range candle. If you'd bought there, you'd be in trouble, right? Because it's sold down, you'd be stopped out here. Or if you're a bad trader, you'd let it go all the way this far against you. I don't let swing trades go more than 1.5 points maximum drop dead for me under any circumstance. You can tell the professionalism of a trader by the small size of their stops. Okay, a good professional trader will tell you swing trades no more than $1. They'll call it a stick, and Wall Street talks a stick. $1 or $1.50 is the maximum you let any swing trade go against you, because good trades that you've correctly identified and scaled into are usually right from the start. Bad trades, not so much. And you definitely don't take a 3-point stop and then watch it run without you, right? So if you've been on the wrong side of that, as I used to be back in the 90s when I was first learning how to do all this I was one of the original .com day traders before all my competitors started copying me and ripping off my site names and my techniques. But anyway, I'm the original guy. And one of the things that I'll tell you is you want to make sure that you understand the patterns that lead to the best breakouts more consistently. So wide range candle, don't buy the day after. Make it break to new cup highs before you start scaling in. Wide range candle, avoid buying the day after a wide range candle. Whether or not it opens up at a minor gap or minor breakout, it's usually going to be a fake out and pull back down against you. Okay? Let's look at some other charts here. I've mainly been focusing on this Tesoro chart because it's such a good example. Let's look at some more advanced strategies. Okay? Green Mountain Coffee. And again, I'm the mechanic. I'm the guy that gets the call. I'm the guy that a lot of traders come to after they get frustrated with other people who don't really trade, and then they realize, okay, yeah, it does help you to learn from a real trader. Yeah, one of the things that you want to look at in window recovery patterns, here's a good example of one. Always be on the lookout for suspicious or reversal candle patterns there. Who can tell me the reason why at least I didn't buy Green Mountain at 40, even though this looked like a good breakout here? What's the reason that I didn't buy here? The reason is, we ran into overhead resistance. This is the bottom of the window or gap, upper gap range here. Sure enough, you saw institutional guys started to sell it there. And that's why you see what? A shooting star, right? Classic shooting star right there. Blow that up for you guys. You can see a classic shooting star right at the bottom of that window. So always be looking for technical clues for reasons to not trade or to stay clear of instruments where they look like there's some kind of previous resistance or some suspicious reason to stay clear of it, right? You just want to focus your energy on the strongest instruments out there. So whenever you see a disconfirming signal, whether it's a shooting star at a high or a hammer at a low before shorting, right? You want to be able to be on the right side of that as you're identifying entries and exits. Here is another good breakout pattern I wanted to bring to your attention. Breakouts are not those like this that are climbing off the low. This is another example of something that personally I am avoiding. I think it's important to give you guys, a lot of these vendors will just cherry pick things that look really good but not tell you the mechanics of how to really trade, right? And the things to stay clear of. Here's another what I call a trap chart. Okay? Trap chart because why? We have a bearish upper shadow here, right? And sure enough, if you had bought here, that's a false breakout because bearish upper shadow, there's resistance, did not provide support, kept selling down. What I want to bring your attention to is this array of candles on the right. From a breakout standpoint, this is a wrong breakout pattern. And the reason I say that is what? What's the story of these 4 sequential candles? Of course, having said that, watch it run up to 80 without me. That's okay. Life as a trader, we get over it, okay? If I'm not in this one, I'm in 30 others, so I don't care. But for the most part, I'm right. Anyway, you always learn to not second guess yourself and move forward with tested strategies that you've tested out in your own trades, because over the next 10,000 trades I do, I'm sure that they'll work out. So I'm not worried about any individual. But having said that, what's the story of these four candles? We have decreasing buy pressure, right? Because the whole real bodies of the candles are getting smaller and smaller, and we see a bearish upper shadow there. Okay, so you have a wide range candle above resistance. That's a good start, get the party started if it were able to catch hold and keep running up. But it is moving up price action wise, but with more hesitancy and with what else? Lower and lower volume. So you notice how the volume is declining, right? The volume bars are the big one, then the medium, the smaller, and then smallest one. That's an exhaustion pattern, and I would rather short this right there and cover here. That would be the duration, the round trip of the trade. I'd rather short there and cover there than look for a new high breakout right above the new high. The earliest I would look at this, by the way, this illustrates another good example. From a breakout price action standpoint, I never buy nines, meaning things that are priced at 9, because that looks expensive to the people trading it. And sure enough, you can see they're hesitant more and more so. This is a lot of buyers coming in. This is less buyers. This is even fewer. And here we have a bearish upper shadow that's telling me it's starting to look a bit tired even in a rally market. So we don't want to buy a 9. I might buy it if it gets over 50.5 or so, but I'd rather short it on loss of support. So when you're looking at candles, remember, always look for a wide range candle, then narrow candles that tell you a story of a reversal, and not buy into that, right? Make sure that you're getting emerging strength or emerging volatility breakout sessions in your momentum breakout entries and exits. Okay, so that's just an example of a reverse. Now, what would be the inverse of this? Well, if these were mirror image, if we saw a small candle here, like here, right? Baby, it was like, I like to read my daughter bedtime stories, so it's like the three bears in the porridge. You got baby bear, mama bear, papa bear. Small, a little bit wider, and even bigger. That's a story of increasing or emergent institutional buy pressure, buying strength in that instrument. So that tells you it's okay to buy new highs. And again, being the conservative trader that I am, I see a bearish upper shadow. I don't touch it until it breaks clear of that, and boom, it's off to the races and out at the first sign of trouble. You see a shooting star or similar type of pattern after a nice breakout. So look for that. That's very valuable too. That's an extra, you have my word, it's a very valuable technique. I use this visually. I'm a price action trader. I don't use antiquated, stupid things like level 2 and total view, nor do I use DAX or other stuff that's irrelevant. I use pure price action. I'm a price action trader, right? Any professional trader will tell you we trade off of price and secondarily volume, but mainly it's price, right? To the price of the instrument. What's the emergent strength in this pattern? You have, no strength at all. It's starting to get a little stronger. Now we got some buyers coming in. That's kind of the obligatory false breakout candle, right? Whenever you see a wide range candle, remember what I said. You do not buy the day after a wide range candle, because typically that's a false breakout signal, as this one was, right? So you would have known not to buy above this wide range candle, without having benefit of seeing this whole day's worth of price action on the upper bearish shadow and that then reversed with 2 red candles, right? You just know from what I told you, you wait until at least the day after a wide range candle and set your entry trigger, say 35 to 50 cents above the high of that upper shadow in this case, and that gets you in on the trade. Okay, so that's an important and valuable tip, as a trader. It's something you can use the rest of your trading life, and don't need any, special indicators to tell you that. Okay, now let's take a look here. One of my favorite recent long-running trends, and this one is in Amgen. We're going to flip over to Forex and to day trading stocks in just a minute, but first let's take a look at when things move, how do you scale in? And one of the things that we know to do, and I don't like looking at the left charts. I don't get paid as a trader unless I'm right over here, because I haven't invented a time machine that I can hop in, or like that Twilight Zone or whatever the episode was. You get the tomorrow's news today and go bet the horses or whatever. The rest of us have to live in real time. So I'm intensely focused on the upper right part of the chart, and how do I make money over there? That's where I get paid if I get it right. But having said that, let me back here into the history of the chart so you can see the type of patterns and how strong they are. Look at this on any of your charts, and we're going to look at day trading charts coming up. So, but these are multi-day, longer-term, many-month charts, bullish cup patterns, usually good to help you get into a trade. Now, what you don't want to do is buy a breakout on following a narrow left side of the cup. They're much better if they have a sharp angle like this that then pivots back up and then takes off to new highs. One of the strategies I teach traders called an acceleration ramp is one in which we're just basically, just visually marking out price action, and what you look for is increasing slope of the line on price action breakout continuation. So the strategy, what to look for is a narrow slope, kind of like a hockey stick, right? Narrow slope that then has a sharp angle, new highs above that, usually good for a breakout. Just as a quick tip though, if you have this would be trade entry 1 setup, trade entry 2 would be up over here, but that's not as strong because the left side of this cup, if we were to mark out the cup, left side of the cup, right side of the cup, the left side is relatively narrow, meaning relatively strong selling pressure, lower lows, lower highs. So you really don't like cups, or I don't like cups where the right side of the cup is up there. And I've never discussed this anywhere for anyone ever in history before, nor published on it. So I always like to give a new strategy that's unique to whatever venue I'm in. So thanks to the folks at MetaStock, and especially to Jeffrey Gibby for having me here so I can share some of this with you. Now, one of the things you want to look at, cup patterns, these micro cups, right? Previous resistance becomes support. Once it pulls back, that's kind of slingshots off to new highs, kind of classic 101 breakout cup pattern trades. Just remember, you want to look for the depth of the cup should be significant. It shouldn't be some grinding sideways chart. There was no good entry signals in Amgen the last few months, right, for multi-week entries because it's been up and down and choppy. The only first entries were generated here and there. Okay. Now, I like the fact that this is broken to new highs. Notice, please, too, what I said is exactly right. We have alternating wide versus narrow range candles. Do you see how they cycle? Here's a wide range breakout candle, a narrow shooting star type candle, another narrow candle here, almost a doji, a wide range candle there, a narrow shooting star candle there, a wide range candle, narrow candle, and 2 more narrows. So we really don't want to trade something like that unless you see a good confirmation with another wide range candle as a sign that institutional buying pressure has in fact come back into that instrument. Okay, let's change gears here to our day trading charts. And one of the things that I like to do is help you identify the strongest of the intraday breakout patterns and also some of the tips and tricks that day traders that we like to use for intraday scaling on the trade. So remember, gaps up provide a good technical ledge or reason to get in. Again, roughly 35 to 50 cents above the pre-market opening range, or I should say above. You have a pre-market range and then you have the opening range the first 5 or so minutes. Typically, it's best to wait till after 9:35. I like to cycle initiate most of my day trades between 9:35 and the 10 o'clock hour. I might scale out at the 10 o'clock reversal. Might do some secondary trades on a rally day after 10, but the vast majority of my day trading work is done by 10:15. Okay, as any professional trader, we like to trade the open. So anyway, you have a nice cup pattern here and a secondary breakout cup and so forth. You can just scale in on breakouts by looking for those opportunities. One of the things you want to do though is avoid entering on days after, like today was a wide range day. So if you see a wide, and by wide I mean at least say 2 to 3 points, you don't want to scale in or adopt a secondary entry on the day after that, or if you do, say you scale and add a little bit, I'd be cautious because typically you have a wide range followed by a narrow range day as we see throughout any of the charts you pull up. Start looking for those wide versus narrow range chart patterns on any time interval, any cyclicity on your charts, and you'll be amazed at how like those word puzzles where there's a hidden word and then once you know what to look for, professional trader, I'll tell you the best of the patterns out there, you want to be able to be on the right side of those. Here's another good example of Vertex Pharma, and you can see a couple of days of price action. Yesterday was really strong. Today's opening range breakout also a good play. And let's see if I pull this up for you. Here is the yesterday's open. One of the things that you want to look at is giving preference to trading those instruments that have at least, again, no good professional day trader worth their salt trade stuff that's under 20 or 30 bucks a share. That's for amateurs. That's where I've lost the most money in my own actual trading accounts trading cheap junky stocks because they look cheap, look like they were bouncing. No, don't do that. I learned that the hard way many times. And whenever I retry it, and it's not about trading skill, it's about internal volatility of the instrument. It's better by far to trade an instrument that has a wide, clean trading range, like Vertex Pharma just recently, right? These last 2 days, this is 2 days worth of price action. Here's yesterday's open, yesterday's close, today's open, today's close, wide range, narrow range, both days good for breakout trades. Okay. Note that this one had yesterday a range of roughly 45 and change up to just under there, just near the 48. So that has a good at least 2.5 point trading range. Similarly today, this thing had a 2-point range, right? 48 to 50. So that's worth trading in my estimation, of those instruments that have at least a 1.5 point previous day's high-low range, because those give you the best juice on today's trades on breakouts. Do not trade under $30 instruments as a rule of thumb unless you want to lose your money. I would much rather see you trade, I don't know, say 100 shares of a $40 instrument that gives you a real fighting chance to make a winning trade like this one does, than 1,000 shares of some crappy penny stock or $4 stock that's going to stop you out and be artificially manipulated by educators and pump and dumpers and low volume, light, thin instruments that you should stay away from with a 15-foot pole. You know, any professional trader, none of the pros that I know trade cheap stocks. They all specialize in 30 to 70. That's what most of us trade. Some of them, some of the high cap traders, those guys will trade Amazon and Apple and Priceline and some of the really expensive instruments. I don't like those because the spread's relatively wide. So the sweet spot of tight spreads within a penny or two, typically no further than a nickel, but usually a penny or so. Very tight spreads nowadays compared to the 90s. Back when we had fractions, right? We had a 3/8 point spread was typical to eat on an in and out on a day trade. Nowadays, we can trade with the benefit of penny or 2 penny spreads. So it's absolutely good for price improvement and for trading the best of the volatility breakout patterns out there. So don't trade choppy charts and specialize in instruments that are trading outside of, like today's VRTX was trading outside of the previous day's high-low, because that's where the money's at. That's where the money shots are always going to be. Because, again, the reason is institutional guys are buying, is I've taught many thousands of traders, too. Over the 15 years I have been publishing and telling thousands of traders how to trade, a lot of that becomes self-fulfilling prophecy. What you want to do is be on the right side of this and make sure that you're looking at 2-day high continuations as your primary breakout strategy, especially good in today's markets. Okay? Just remember, you get a wide range day followed by a narrow range day. Pull up the S&P, the NASDAQ, the Dow charts. You get the same thing. Yesterday was a wide range rally day. Today, not so much. But a meh day, right? It's a half range day following a wide range day. That fits in very nicely with what I told you about wide range versus narrow range candles. That alternating breakout strategy, what you do is look for the entry on the third day, right? If you miss the big breakout, you sit out the day 2, but then you look for another move on the third day. And for example, here, this is not a trading recommendation, but I would be setting an entry roughly 30 cents above the nearest whole number resistance. So I would be using, say, 50.3 as kind of a default for entering on a continuation long breakout for either a swing or a day trade. Okay, now let's take a look at this chart. I thought this one would be interesting too. This one's Verifone, or PAY. PAY paying us, you could see it. This is a cheap one. I generally, again, don't like the under $30 instruments. I'll go as low as 20, but very seldom. I was trading Research in Motion earlier on its volatility at lower price, but for the most part, we like instruments at least 30, no less than 20. Anyway, so PAY did break out over the 20 today, and again, the thing you're always looking for is a classic micro cup pattern. Again, always, let me pull this back here for you. Always look for a bullish cup pattern. Again, it looks like the letter V or the letter U or the triangle, whatever you want to call it. You're looking for a U. I like calling it cups because that's what it is. And then the exit signal is generated by 2 red opposing candles that go against the trade. Or if I'm day trading this, that would be for a swing trade. For a day trade, anywhere from 8 to 15 cents under the high. So where trailing stop once it moves and you see, for example, 2 red candles, you can put the stop at, say, 8 cents, no more than 15 cents under the low of the second red candle. Okay, so you'll never be able to correctly guess the high, but what you can do is get out at the first sign of a reversal, as evidenced by 2 red candles after you've got into the trade. So that's the breakout signal 1. You're in it, and then, if you're kind of marching through time like this, say, okay, I bought there, didn't really want to scale in, looking for, okay, now I know that the trade's about ready to be done, and you put I use sell stop limit orders or sell stop order, and I'll put that in as soon as I see the second red candle, and that gets me out automatically at, say, 8 cents under the support line, right? And that's how you do the round trip, the entry and the exit. You cycle over and over again for professional breakouts. That's the type of chart and the type of pattern for entries and exits that you want to use. So is everyone clear on that? So you've got a bullish cup. You get in at 8 to 15 cents above the high for a day trade, up to 35 cents up or so for a swing. And the exit signal is when you see 2 red opposing candles and you get out at right under the low of the second red candle. If you're following it live, that's how you do it. If you're not following it live, you can just use, say a 15 cent trailing stop. If you set in a good to cancel order, I use a 15 cent or so as a trailing stop on the trade. And let's look at a seller's chart. Here's a good example of one. This is 3D Systems. The ticker on this is DDD, and this is a good example of a bear cup and a gap down continuation, right? And this is one, and again, I posted the alert for my traders. This is a short play because it's a gap down, and we go in trend for the gap. So this is a down move, and we just look to sell it on new lows, right? And then get out at the first sign of 2 green candles on the bounce. Right? You can sell it on new lows. Maybe that one's, say, scratch trade. So first trade win, starts to bounce. We get out, so we cover. That's a winning trade. Maybe short new lows, and then it starts to bounce, and we take for hitting singles and doubles and not home runs. And that's very, very true, as evidenced by at least all the trades I've done in my own accounts. Is you're looking mostly just to grind out trades and make your small stops be less expensive than your wins. And the way you do that, or at least the way I do it, is I double into or scale into a breakout or breakdown depending on the direction of the trade once I'm in it. So that's another strategy, to give some thought to. Okay, now let's shift gears just a minute here for Forex. And what I've got here for you is our dollar CAD. The US dollar against the Canadian dollar has been real strong this last week and a half or two, right? It's taking out new highs up near previous resistance. One of the things you need to get used to as a breakout trader is avoiding false breakouts. And even, even the best of us, occasionally you'll take a small hit. Let's say this candle you stayed out of, but you got in on this one. You didn't know it was a bearish upper shadow or tweezer bearish pattern up there, and then you take a stop there. But then to set your secondary entry, right? The second, so that would be, say, you get in there. That would be a likely breakout that then, again, no more than 20 or 30 pips is a stop, right? Never, ever use more than 30 pips maximum on any Forex trade. Only a moron would use a huge stop. Make sure, just like with E-mini trades, you do not take 2 and 3 handle stops, or 8 tick stops. Only morons and amateurs do that. Professional traders, we're all about keeping our losses as cheap as possible. Okay, so lose less money. On the count of 3, can I get everybody around the world, wherever you're in from, to say lose less money? Okay, this is lose less money. That's really important. So, example of my real trades here from one of my trading days. Yeah, I was wrong more than I was right, but I still made $660 net after commissions on this trading day because I scaled in and nurtured the trades that worked and took itty bitty tiny $3, $4, $5 stops. I think the biggest stop was $40, right? Biggest win was 170. The vast majority of the small stops and shots I took at the market were only $3, $4, $5, $6 stops. So that didn't cost me much in aggregate, and I more than made up for it with the winning trades. So anyway, so you take a small itty bitty stop there, you scale in or you get in on the next breakout, and sure enough, that one's the one that works out. And so what you don't want to do is be a nervous trader who's on the edge of your chair over trading choppy charts with too large size and taking too large stops and not being here with the rest of us traders in 10 years time. I want to see you guys. It's in my best interest as an educator. It's in my best interest for my partners that I work with, like MetaStock, to see you guys alive and whole 10 years from now, actively trading, hopefully better than break even, and actually potentially even making some money, right? No promises about making big dollars. You may take several years just to learn how to be a break-even trader, and that's perfectly fine. Do not expect that you get to be an instant winning trader overnight, no matter what any vendor will tell you. The truth is, it takes years just to learn how to be a scratch trader. Just like it takes years to learn how to be a scratch golfer or playing piano or guitar or anything else. To get moderately competent takes years, and so that's the price you have to pay. The smart way to do that is to do that on the cheap, as inexpensively as possible, which means itty-bitty trades, really tiny stops, don't overtrade, only trade the strongest patterns, and learn your timing, entry, and exit skills. Good trades are usually right from the start. If it doesn't work out, it'll tell you real soon. You don't let it go all the way, down here and then stop out and then sit on your hands and miss a big run. You instead maybe take the shot on the first breakout, get a minor stop. Okay, well, that's pain. It's a small bit of cost of being a trader, but you're also equally ready to scale in on the next time it breaks out, and that is the one that works out. And you will find, again, I've traded thousands of trades. You will find that that is the life of a trader. You are taking a series, kind of like waves in the ocean. They're cycling in and out, back and forth. You're kind of washing, looking for gold in one of those gold mining pans, and you're kind of washing out the sand to get the nuggets of gold and all that. You're spending a lot of time and energy as a trader, as a breakout trader, working the market adaptively, flexibly, strategically, sensibly, carefully, working your order flow and working your market entries and exits in a way that professionally gets you in on the right side of things in aggregate from a P&L standpoint. Do not worry about being right on 50% plus of your trades. You ain't going to get there, all right? The best professional floor traders I know in the Chicago pits, they're right maybe 26, 28% of the time. The conversation that they never have in their entire life as professional floor traders is, what percentage of your entries did you go right? No, the question is what? How much did you make? What's your net? How much money did you make or lose on the week or the quarter or the day or whatever, right? All we care about is the money. I'm in it for the money. I'm very, like the quote from Han Solo in Star Wars, I'm in it for the money. I expect to get paid. I'm very upfront about that. I'm a capitalist. I like to make money in my trades. I trade for money. I don't trade to be an analyst. I don't trade to talk about chart patterns. I trade because I want to make money, and I want to teach thousands of traders, at least my path and the kind of things that I do in my own trade. So be real clear and real explicit about your goals. It's to donate as little as possible on little tiny breakout attempts that don't cost you much when you're wrong. And when you do make it, you make some coin, right? And that's what you're trying to do as a trader. Don't get exotic. Don't get brave. Don't get, hey, I'm a poker player too, and I won my first tournament in Vegas back at the Luxor back in 2011 in summer. But you don't shove all in your trades and say, okay, I'm going to go all in because I got trips on the river or something. Yeah, you want to instead scale in and out very carefully in your trades and realize it's going to be a series of dozens, hundreds of small trades. And the story of those from a breakout trading standpoint, especially from a position sizing standpoint, is one in which you take a lot of small shots that don't work in pursuit to the ones that do work. And even if the ones that do work are 1 out of 3 or 1 out of 4, if you properly scale and you're good at it, you can potentially easily overcome the cost of a series of itty-bitty stops along the way. Okay, the key is the strongest patterns, pattern recognition skills, combining candles with Western technicals like your bullish cups, and the rest of it to be on the right side of your trades as a trading professional or a home trader, retail trader, depending on what your status is, trying to be on the right side of these things. Okay, so when a trade entry 1 is going to be 20 to 30 pips above that cup pattern high. The secondary entry, it depends if you're scalping. When I'm scalping, I will use anywhere from, say, 20 to 30 pips on a secondary entry. I may be very aggressive. If I'm swing trading, it might be 80 to 120 pips, say, on the next day or the day after, over a week's worth of trade. So it depends on your trading style. I'm just kind of anticipating questions. What are the entry signals? How do you scale in? How do you get out? You always get out with no more than, say, a 30 pip stop or 2 red candles going against you that lose support. That's enough to get me out of the trade. It's not quite a red candle. It's more doji than anything, but because it's red and there's a second red, that would be fine to get out. So you're in, maybe in again, and get out there. And you sit out this chop, get in again, right? If it breaks new high resistance, be cautious of the fact that your exit target on the trade would be right under the resistance. So you might scale in here, and I would not do a secondary scale in. The life of the trade would exist between here and here on the US dollar to the Canada dollar. And this is the same on stock charts too. If this were a chart of Starbucks, it would be the same exact strategy, just with different scale of measurement. But as a visual price action trader, those are the type of things you want to start looking at. Now, the monster currency chart has been the US dollar to the Japanese yen, and then we've done really good against the yen. It's a good time to travel to Japan, by the way. Our dollar's much stronger than it has been for quite some time. Look at the US dollar to the Japanese yen, right? It's gone way, way up here from, it had been down in the, I think it was 87 or so. Now we're all the way up to 94. It's been strong against the Canadian dollar as well. So our US dollar is finally starting to get some strength. No thanks to our politicians, but I won't have that conversation because it gets me all riled up. Anyway, they fire them all. Anyway, but we have cup patterns. Notice that the handle pattern, the congestion, is at the right side of the cup. So if you do say take a breakout and then get a stop, avoid trading until you get a new high breakout, and don't overtrade, don't retrade cup breakouts. If you get a breakout that's a fake out, you get in on a secondary or tertiary trade, and you're looking at, you're in and out. Maybe you get in and you get out at the first sign of trouble, so a tiny win. You wait a bit. This one, okay, that one finally took hold, and now you got something you can work with. So you may have one stop, one break even, or minor win, but the third one, that's the one that's the charm that really worked out. So be persistent as a trader, right? That's one of the things that I want you to start focusing on, as you're looking at entries and exits, is how to scale in more dynamically. And don't be afraid to take very small stops in pursuit of the wins, just making sure you're looking at the very strongest of all the charts out there. I like how cool the MetaStock charts work. They're really nice to be able to instantly flip across different time intervals. If you're like me, you always look at multiple time intervals. So anyway, here's the longer term story. The US dollar to the Japanese yen, that had been an interval chart. I flipped over to a daily, and you can see how well, simple cut breakouts. Again, you've got a congestion region that might cause you some trouble. It's trouble. But the second one, that breaks out. So don't be afraid to say, breakout, okay, got stopped out. This one, maybe break even. But this one, that's the one that takes off and makes you whole and then some. And what you're looking for as a professional trader is always how to scale into these things dynamically so that you're scaling up and adding to winning trades, right? And you can just think, this is from December. This is December, just a few months back. The US dollar to the Japanese yen, we've gained significantly, right? It's starting to give back some now. We're starting to see some weakness is evidenced by this wide range red candle, and it's kind of an inverse pennant, or the bane of traders. The bane of breakout traders are what we call expanding range breakouts. Looks like a megaphone, a bullhorn. It's something that looks like an inverse pennant, and the reason is why? Because new highs, take out, say you buy on a new high horizontal resistance breakout, and then stop. And then let's say you short what looks to be a breakdown, and then you have to cover stop out because it starts to bounce. So whenever, another breakout avoidance tip on false breakouts is whenever you see an expanding range like this, where it's kind of ping-ponging in an ever-expanding or ever-increasing triangular range, that's a breakout pattern to avoid. You don't want to trade once it's taken out new highs and new lows like that, because it's likely to take out multiple support and resistance levels. You might buy the breakout and you get faked out, and then you short the drop of support, and then you get faked out as a bounce, and so forth and so on. So when it's expanding like this, an expanding range breakout is something to avoid as an active trader. You always want to just do consolidation cut pattern continuation moves on new highs as you're looking to build a trade series in that particular instrument. So I hope this has been genuinely helpful. These are the kind of things that I do in my own trades, and I hope that it's been something that's useful to you in your own trades as well. Now, here's an example of our pound dollar, right? The British pound to the US dollar, and you can see that we've got bearish cup support here, one of the things to look at is what I call the sandwich pattern, where you see, or Christmas tree pattern if you want to call it that, alternating red, green, red candles at a key support, or this is support, or up at a resistance area. Well, in this case, it's at a support. You see a wide range. Zoom this in here so you can see it clearly. There's a hammer there, and we got a bounce, boom. Didn't see a shooting star. Well, there's a shooting star, so actually they're supposed to be at the exact top of a breakout, say like right there, and then it sells down. But anyway, bearish upper shadows here. It sold down, started to bounce. There is a shooting star, and then it sold off sharply. You can see here this is more likely to sell on off than anything, but this is a likely support level. So if I saw a hammer here, which I don't, but if I saw a hammer or bullish engulfing, say a wide range green candle, then I'd buy above the high of that. Since I don't, it's more likely, I would estimate, to sell on off. So if we start to see new sell pressure, again, look for this alternating wide range candle, narrow range candle. Here's another narrow. We're likely to see another big wide range candle, most likely a selling candle coming up, you know, momentarily kind of thing. So keep an eye out for that type of pattern as well. So always look for your hammers, your shooting stars, your pivot points, and the rest of it, and look for alternating volatility signals as evidenced by what the buyers or sellers are doing with the wide range versus narrow range candle approach for equities, intraday stocks, swing trading stocks, any time interval. It's a very good set of skills to start working on for visual pattern management. Okay, let's see what else we have here. Here's one that moved relatively strongly and then started to give some back. And whenever you see, for example, a gap that continues and then starts to fade, that's a broken gap trend. And that's another breakout avoidance pattern. Again, I always, like I tell you, gaps tend to continue. In this case, it surely did, right? It gapped up and it moved up 5 points, right? It gapped up. Here it gapped down and sold down 2 or 3 points. Then started to make a cup. Whenever something misbehaves like this, or you're seeing alternating up versus down gaps on a swing trading chart or daily candlestick chart, avoid trading it because you're just gambling, right? If this were a series of gap up continue, another minor gap continues, a big gap up continues, great. That's an in-trend continuation. This I look at kind of like a pencil that you snap in front of you. It just got broken, right? It's a broken trend because of the gap down. So we had good strong gap up that continued, and equally, well, not quite equally, but almost equally strong gap down that also continued for a bit. That makes for a much tougher chart to trade. So you really don't want to trade anything that has alternating up versus down gaps. That's the writer downer strategy. I've never revealed that before anywhere either. See kind of a doji here, spinning top. Anyway, you have alternating up versus down gaps, and what I want you to do as a trader is avoid anything that's not consistent. Just like people, avoid anything that's not consistent. It's not telling you a story that makes sense and is credible and believable and all adds up. And so when the story of the price action doesn't add up, that means the traders aren't sure what to do with it either, and so we don't want to be anywhere near that type of instrument because we don't know which way it's going to move. So look for reasons to disqualify trades as well as, you know, great professional trading signals to get in on them as they continue to move on up. Remember to look for patterns where you have narrow candles versus wide candles. Remember, itty bitty candles, they get bigger and bigger. That's a long signal, right? Like this one. Small candle, big candle. You can all remember to look for that. Small, medium, large, or small, large. You buy new highs after the day after that wide range candle, right? As soon as it breaks resistance. That's the long signal. This is the opposite of that, where you see narrower and narrower candles that are telling you that some of the selling pressure is starting to work into that stock or that instrument, and you want to stand clear of buying new breakouts, or at least control for that by using lighter size than normal. So instead of, say, 100 shares on a breakout at 50.5, I might only try 20 shares because I'm skeptical because of those opposing green candles that tell me that it's more likely to run out of steam than to pick up volatility. So look for the patterns, the cyclicity, the cycles of the candles are really easy to see here in the MetaStock interface. You can see exactly where things are moving, and you can always zoom in to see even closer, which is a really nice feature. You just click on the plus or minus buttons there and see exactly where the patterns are, so you can do a multiple time frame analysis with a click of a mouse. And that's another good, good tool, or something I like about the platform. It's neat. The folks at MetaStock are always developing. This is the new one. I think the version 12, right? It's the they're always coming up with new updated software on a regular basis, which I like. So that's always good to see them working to be ahead of the curve and meet the needs of the traders. So that's good. And those, you're in the right markets for breakout trading. So I hope that I've illustrated for you some of the patterns and the things to look for. I guess that about wraps us up. For more on me, you're welcome to join me in my Saturday shindigs at Daytrading University. I'm up to over 1,500 registered for those events. Those are my Saturday trading week ahead events where I go over everything I think is worth trading for the week ahead. And you can get to that just at Daytrading University, or you can shortcut as daytradingu.com, and that will have the link for the Trading Week Ahead events every Saturday. So anyways, thanks so much for having me. Appreciate it on behalf of the folks at MetaStock and for all the traders around the world who have logged in. Jeff, we have a few minutes left here. I wanted to, extend a big thanks. Jeff's been trying to get after me to work with them for years now, and we finally starting to get that together. It's my fault because I've been so busy. I'm just swamped. I'm an army of one with thousands of traders and just me, so it takes me a while to get things done. But hopefully, as everyone can see, this is well worthwhile, worth learning. These are good professional trader strategies, and I hope that what I've taught you tonight can help you genuinely become more successful, and then you come back to me for more in the future, right? But I need to prove my value to you at no cost first. I think that's the first step in building any kind of a great working relationship, both with the folks at MetaStock and with all the traders watching tonight's broadcast. So thanks, Jeff, for having me. I appreciate it. For all my traders watching this, you might want to try out MetaStock, and I don't know, Jeff, if you have any information on how they might get started with that, but I know a lot of my traders who may not be using MetaStock may want to figure out the next steps, how to get started. So is there a good way for them to get a hold of you or the team at MetaStock to try out the platform and take a look at it?